Hello and welcome back to Invest with Humility. My name is Bruno, and on this video we'll be covering Introduction to Stock Market Investing. A brief recap of our past videos that we made. We discussed retirement plans. Again, if you enjoyed those videos, please give me a thumbs up. If you want me to cover IRAs or any more details about retirement plans, or if you have any questions, please leave them below. I'll also post a poll to see, if you need any more information regarding retirement plans. Moving on to the topic of the discussion of this video is the introduction to stock market investing. Now you may be asking yourself, why should you be involved in a market? Okay, there are mainly two reasons to be involved in a market. The first is to invest or trade your savings, or to manage or trade other people's money. In both scenarios, your objective is to make money. Okay, so our objective to be involved in the stock market is to make money. Now you may be asking yourself or saying that, I don't need to be involved in a market necessarily. That is well and good, but chances are if you're in the United States, you'll be working, for like 20 to like 40 years, and your money, if your employer gives you, the 401 benefit or any retirement plan benefit, your money will be invested in the stock market. So it's better for you to take a few months or a couple years to learn how the stock market works so that you can make wise investment decisions. Because if you do not know how something works, chances are your money will be invested for you. Now, that can be a good thing, or it cannot be a really good thing. It can be a good thing if you make money, but it cannot be a really good thing if you lost money. You just went based on what your advisor told you or what you heard. So that's why I'm making this series of video. I cover from the little things all the way to the advanced things, explaining these concepts and making sure that you understand them in a sequence, in an order that you can follow along. Okay, so if you have any questions, please leave them below again, or you can proceed and give us a thumbs up. And let's proceed. So what is a stock? So a stock is a type of security that signifies ownership in a corporation and represents a claim on a part of a corporation's assets and earnings, also referred to as shares or equity. Alright, so when we buy a stock, it signifies that we own part of that corporation. Okay, now you may be asking yourself, why would a company doing so well want to issue stocks? That is a very good question. I will show you this picture here. So as you can see, companies issue stocks to raise capital, and then companies receive money from the initial public offering, and then companies use the funds to raise to generate the revenue in the company. Now later, the shareholders, the people who invested in the companies, sell shares to make profit. So that is simply the reason why a company would issue stock. So let's say, I'll give you a real example, right? Let's say I own a drone company, right? And I sell drones together with other electronic accessories, right? And I make $200,000 a month doing that. Now my store is in one location, and I want to expand my store to go to different locations in different states. And I have identified to open a store in different states, I'll need about $1 million. Now I do not have $1 million currently, and I'm only making $200,000. So I can either save that money for a couple years before I'm able to open stores at different locations, or I can go to investors that I know and ask them to invest in my company. In return, I give them shares to my company, so they own part of the company. So previously, when I was making $200,000, I owned 100% of my company. But now I issued share to the investors depending on how much I've raised and how much I negotiated. Let's say the investors, they own 40% or 50% of the company. So I take the investors' money, and they automatically in own, let's say 40% of my company, and I still own 60% of my companies. But this time I have 5 or 6 different stores because I've taken their money and I've gone to open stores at different places. Okay, so at the end of the day, depending on the terms of the agreement, that you make with your investors, when you make money, they also make money, and they take part of the earnings. They get part of the earnings, as well as if your company performs really well and in the future they decide that, hey, I want to move on from this company, they can sell their shares to make profit if the company is doing well. Now, this also needs to be said that if the company is not doing well, then the investors can lose money. So it's not just you as an investor, just because you do not have to work, it doesn't mean like you're not taking a risk. Whenever you're investing in a money, your money in a company, you're taking a risk. So you just have to agree with, either, the wins or the losses. You just have to accept them. So that's why it's important for you to do your due diligence before investing in a company. All right, so let's go back. Okay, so one thing you need to understand is that when a company initially starts, a company is typically private, right? That means a company owned by a relative small number of people or shareholders, and which does not offer its company shares to the public on the stock market. So when a company initially starts, let's say it may just be you and a couple of investors, and it's just a small circle. So at this stage, it's really hard for companies to raise money because they're not public yet. They may not be known yet so well. And so at this stage, their efforts of expansions are really limited, because even the people who can participate in private companies are qualified investors. And I think right now in the US, you need to have assets which accumulate to up to $5 million. You can look that up. So even if a normal person may want to participate in the private company, they may not really be able to do so, if they are not, qualified investors. Now, if these people who own this company privately, then you have a leeway of participating in the company and investing in the company. So you may be a shareholder easier that way, but chances are, they you do not know these people. So to participate in a private company, it can be pretty hard. So that's why companies go public. And what are public companies? So a company whose ownership is dispersed among general public, and their shares freely traded in the stock market. And this is where we will be participating. We will be participating in the public company. Okay, in public companies which are traded on the public exchange. So this is where companies go through an IPO process, and they're officially being able to be traded into the stock market. We'll discuss more on IPOs and how they work in the near lectures in the futures. But essentially, we will be participating in the public market, and what we're going to do is take advantage of the mispricing that is in the stock. If either the stock is really high based on the good news, or if the stock is really low and we think that it may go higher based on the fundamentals and the technical analysis that we're going to look at. So that is where our attention will be. Okay? So I hope you enjoyed this video. I hope you got some understanding. And if you have any questions, please feel free to leave them below. Give us a thumbs up, and be on the lookout for more videos. A lot more content is coming. This series will go for a couple months because, as you can see, we're starting from the lower level all the way to the most advanced concepts, and trading techniques. So if you're excited, please follow along. Until the next one, thank you. Be blessed.